Welcome, real estate friends. Thank you so much for joining me today. We have a very special thing we're covering. It's one of the most important aspects of multifamily real estate because it is how do you value your property? Property and commercial real estate, specifically multifamily, isn't determined like in residential real estate based on comps or replacement values. One way to value commercial real estate, but the primary way to value commercial real estate, specifically multifamily, is based on the net operating income. How much cash does the property actually produce? And that's what we're going to discuss today. Now, a couple things here. We're going to go over a formula that's very important, the only formula you really need to understand when determining this. And we're going to show you how the calculations flow and work through that together, right? So I know if you aren't super inclined with math, don't worry. This is super simple and super easy. So we'll talk about it as we go through, and we'll use a lot of examples. So you'll be a master by the end of this. Now, remember, like, comment, and subscribe. If you like this content, please like, comment, subscribe because that helps me out, it helps you out, it helps everyone out. It's good for you, it's good for me, it's good for the entire world. So I really appreciate the support, the love and support that you're giving me, and thank you so much for watching my content. Now, as a reminder, as always, this video is accompanied by a blog post on my blog. The link is in the description below. So if you want a more detailed analysis of what we're talking about today or want to go over it in written form, please check out that blog post and you can take a look at that there. Now, when evaluating a property, there's one formula to determine what the value of the property is. We'll show you how you actually derive that formula because it's based on another formula that is a common formula, and it involves cap rate. Now, cap rate is a capitalization rate. Now, cap rate is described by many ways, but one way to describe cap rate is how much additional net operating income is derived per additional dollar in purchase price or property value. So the formula for cap rate is cap rate equals annual net operating income over purchase price. So you divide net operating income by the purchase price, and that gets you your cap rate. If you're familiar with math, then it will make sense to you. What I just said is this formula shows you that the cap rate is how much additional net operating income per $1 increase in purchase price. It's just a way to describe the formula, and that goes to show you there. Now, cap rates. This is important, right? Because when you're determining purchase price or property value by rearranging this formula, cap rate comes into play. Let's talk about it. Cap rates range anywhere from usually 5 to 12%, with luxury type A properties closer to the 5% mark, and proper type D properties close to the 12% mark. And in general, I was just reading an article about Camden Properties. It's a big REIT, real estate investment trust, that has over 70,000 units, usually traditionally in the Sun Belt area like Texas and some Southeast properties and whatnot. And just in quarter three, they were mentioning of this last year, this year in quarter three, they were mentioning that the properties were trading at a 5.25 to a 5.5% cap rate, which is standard for the type of real estate they invest in, which is traditionally not anything that's built past 2016. So 2016 and newer is usually the properties that Camden invests in, and just gives you an example of what kind of cap rate they're looking at. Now, using this formula, we can rearrange it to determine property value or purchase price, another way for purchase price. So if we rearrange this formula, we can see that purchase price is actual annual net operating income divided by cap rate. Now, that's going to be the most important formula in determining property value. It tells you right there. How do you figure out the purchase price or the property value? It's annual net operating income divided by cap rate. As an example, say you're using a property, you have a property that's producing $100,000 in net operating income annually, and you use an average cap rate of about 8%. We can determine the property value, which is $1.25 million. There we have it right there. Purchase price, $100,000 divided by 0.08, which is 8% cap rate. That's $1.25 million is the purchase price or property value. We use those interchangeably because the value of property is what the purchase price is. It's the same thing. Okay, so there we have it. This is how we determine the value of a property. Now, What if we want to determine how much additional property value, say something like a common example of raising rents is, right? When you're repositioning a multifamily real estate property, a lot of times you're going to be raising rents. You're finding properties that maybe have lower than market rents or various other expenses, maybe higher expenses. The same thing goes as an example, right? If you have higher than usual expenses, you bring those expenses down. Traditionally, gross revenue divided by gross revenue minus your operating expenses gets you your net operating income, right? And so if you decrease your expenses, then you increase your net operating income, or if you just increase rent, you increase your net operating income. So we're going to take a look at this common example and helping you determine how much additional property value or purchase price you get by raising rents. Here we go. Additional property value. So for example, we're going to take a simple example. Say you have a 20-unit apartment building and you raise the rents by $100. How you can determine the annual net operating income increase is you take the 20 units times $100, which is going to give you your $2,000, which is how much additional net operating income you create per month. And you multiply that out by the 12 months to get your annual net operating income, which is about $24,000. We can see that example right here. You take your additional net operating income equals the number of units times the rent increase times 12 months. So in this example, the additional annual income is 20 apartment units times $100 times 12. It's $24,000. Great. Now that we have the additional increase in net income that we have from raising our rents $100, we can determine how much additional property value that's created using an average 8% cap rate just for this example. Based on your market conditions, what type of property you're buying, and all these other factors, you can determine your cap rate that you can utilize for your calculations. But for this example, it's just an average 8%. So we use the same formula as before, where we have annual net operating income divided by the cap rate to get you your purchase price or property value. This is just additional. So we have the equation here. Additional purchase price equals additional annual net operating income divided by cap rate. So that's $24,000 of additional net operating income that we created divided by the 8% cap rate. And you can see here that we have an additional $300,000 created in property value or created in the purchase price. Isn't that amazing? Wow. That's how we do it. It's really that simple. And this is all we're going to cover today. How do you determine property value? It's using the simple formula, which is annual net operating income divided by your cap rate, and that gets you your property value, your purchase price. So there we have it. Thank you so much for joining me. I really appreciate your time and consideration in watching this video. And if you're reading the blog, then great. Read the blog and have fun with that. All right, your multifamily real estate expert, Connor Scott McCarl, out.